Expectations of a hawkish FOMC meeting leave markets nervous. Cracks start to appear in retail favorite sectors as sentiment shifts negative. And the last options expiry of the year could bring some fireworks. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 14th of December, and let's have a look at these markets. Risk assets last week took a bit of a breather, trading pretty sideways as the market digested the sharp round trip that we had on the Omicron fears, and then the prospect of an accelerated tapering, which has become more clear after the Fed dropped the word transitory. So those have been the two main themes really that the markets cared about. Now, if we look at the Omicron stuff, right? So we've got South Africa obviously leading the way here in terms of data on this new variant. And, we can see that the peak in cases, it looks like we've had our peak in cases out of South Africa in the Gauteng area. And that peak had actually come in a little bit less than the Delta peak was, which is good. And then the most important thing is that deaths are like 25 times lower. Okay. So from that perspective, the market's kind of been a bit more sanguine because that's really what matters, right? Hospitalizations and deaths. And whilst it is spreading like wildfire across the world, if less people are going to die and it's less severe, then maybe this is our way of getting over this pandemic, right? A little bit. So that's what the market's pricing in. And you can see on the chart on the right that if we look at the growth factor, so it's a style factor that is the growth factor in markets, then it had a move down. And these style factors don't move that much in absolute terms, right? But this moved down on the news around that Thanksgiving period pretty sharply. And it's recovered, more than sort of 2/3 or more of that if we look across all the regions, Euro, China, and US, right? So markets definitely showing us there that the hit to growth that was potentially feared when this thing first popped up is kind of starting to get priced back out again. So that's what we're seeing with regards to Omicron. Now, the Fed is really the big one, okay? So obviously loads of central banks this week. But the one that everyone cares about is the Fed. And the reason being is the Fed is so behind the curve. Is this now the time that they finally decide, okay, we need to catch up? Okay. And obviously by dropping the word transitory, they kind of spook markets a little bit, in certainly rates markets. I mean, equities managed to shrug everything off these days, right? But, I think that's what the market is going to be really closely watching this week, right? The Fed on Wednesday. Now, if we have a look at what the expectations are around that, these charts kind of show us that, the expectation is they're going to double the speed of tapering. If they do that, then you'll see, by March, asset purchases are kind of done. So that's the pace at which they are, potentially going to be reducing QE. Investors, what do they expect in terms of rate hikes next year? Well, this is a B of A global fund manager survey that they do every month. And so you can see the turquoise versus the light blue. That was November to December expectations. And we've seen a lot more expectations come through into December of 2 rate hikes, basically. Okay. So the number of participants saying 1 rate hike has gone down and 2 rate hikes has jumped. And some have even jumped to 3. So more people saying 2 or 3 hikes next year over the last month. Basically, that's the change in investor expectations. If we then look at what Goldman's are saying, well, Goldman's are basically calling for 3 hikes. They're obviously, they've got this timeline. They're expecting the liftoff in May, the first hike to come in May, then July, and then another one in November. So that's what they're calling for. And if we compare that to the chart on the right, to the dot plot that we had from September, on the higher end of and above any of the dots from September. So those dots are obviously going to have to be revised up. But if you look at the longer run, the market has got a much lower expectation of rates at around 175 compared to all the dots that we had in September, which were between 2 and 3%, basically, right, for the long run rate. Now, so we know that the dots are going to have to go higher in the front end of the curve. The real question is going to be what happens to the longer term dots. Do they fall more in line with the market? And basically saying that, yes, our rate hikes are going to bring inflation down, but they're also going to bring growth down? Or are they going to just increase all the dots in a more parallel fashion? And then what is that going to do to the market? Is that going to then spook the long end of the bond curve, of the yield curve? And basically the market's then that long end's going to sell off to go more in line with the dots? Or is the market basically going to call bullshit on the Fed like they have been doing and keep that long end yield lower because they're saying you're making a policy error here because yes, you've let inflation run away from you, but the market can't handle a long run rate greater than 2%, basically, right? You're going to crash the entire economy. So that's really what we're going to be watching out for this week with regards to the Fed. Okay. Julian Brigden has been pretty vocal about saying, you know, they are so behind the curve, right? There's behind the curve and then there's this. He spoke to the guys at Macro Voices last week, put out a really decent slide pack, which I recommend everyone download for free. You can if you're on Macro Voices website. And I'll share a few of the sort of key takeaways that I got out of that report. Yeah. So then, you know, other charts we need to be aware of, you know, if we really do stop growing the central bank balance sheet as we expect to with tapering, and we do really tighten financial conditions, well, what do we expect to happen to asset prices? And then you've all seen this chart of the central bank balance sheet going up in a straight line. And that is the big liquidity support for the S&P. So you've got the S&P, you've got the central bank balance sheet in white, you've got the S&P in green. And the idea is by sort of April next year, that white line is going to stop going up. Okay. And so then what happens to the S&P? What happens to the market? The thing that's been underpinning the market. And this is something Darius has been talking about as well, right? That liquidity issue, we are heading into that in towards the end of Q1 next year. And what's that going to do to asset prices? So you look at that, you know, Julian's basically predicting 48.50 projection by April for the S&P. That's not a lot higher than where we are now. That's the potential blue sky upside in his opinion. And yeah, he is definitely in the bearish camp, right? And risk assets. Okay, there's other people who are more bullish, but you know, he's looking at 48.50 projection to the top side. And by the time, and maybe, you know, markets used to price these sort of things early, but it seems more and more now when you're in a world of stimulus and liquidity, until the liquidity actually stops coming, the market can keep going higher, basically, right? So potentially we keep grinding up until sort of March, April next year, and then we're going to maybe face a bit of a problem. If you look at the bottom chart, that shows you high yield, junk bond index, junk bond ETF, HYG, and basically just it's got the GS financial conditions index, and saying that financial conditions are super low, super easy. And whenever these things do tighten, they tend to come along with a drop down in the high yield, basically. Right. So the credit market is going to be susceptible to some corrections when financial conditions do finally tighten up. And that's what we're heading into, basically. Whether we're heading into it in the next month, two, probably not, but certainly by middle of next year, that's where we're heading into. And HYG might have a bit of a problem. Okay. Now, whilst the markets were rightly looking through Omicron, I do think the market is missing just how huge this hawkish pivot is from the Fed, right? Compared to anything we've seen in the last decade. You know, we've always seen dovish pivots, but for a hawkish pivot of this magnitude, where they pretty much hold their hands up and admit we got inflation wrong, market's probably a little bit too sanguine about that, right? Vol, maybe not. Vol and skew are kind of pricing a bit of risk here, but given the level of where the market is, you know, that's surprising. And I think really, if you look at the internals of the market, you start to see why that is, right? So the breadth in the market is pretty shocking. You know, NASDAQ, the gains in the NASDAQ, if you break them down into which stocks, this pie chart here has got, obviously, you can't see all those names, it's all a bit blurry. But the point is that 60% of the entire NASDAQ gain year to date has come from Microsoft, Apple, Nvidia, Alphabet, and Tesla, right? So that is insanely narrow breadth in the market, basically, right? You've also got the chart on the right showing it a different way. Percentage of members above the 200-day moving average is tanking as the market's at all-time highs, okay? That's generally not very healthy, right? It's hard for that dislocation to remain. So we're either going to have to get a catch up in breadth and we're off to the races and we keep rallying and all these unloved stocks kind of catch a bid, or the market needs to kind of pull back a bit and correct there, okay? And then under the surface, we're seeing the meme stocks getting pummeled, right? So you've got a meme stock basket here, retail favorites. How's that been performing? Well, since November, it's been crushed, right? It's lost about 25%, okay? So usually these sort of names, these kind of retail favorites, these ultra high growth, no earnings type names kind of are the first to go when confidence kind of goes. And we're seeing a similar story in crypto where confidence is kind of leaving that hot space, that meme space, let's call it. That's a bit of a crack under the surface of the market that we need to be cognizant of, I think, right? Yeah. So for me, I think raising a bit of cash, if you've had some gains in risk assets, raising a little bit of cash ahead of the FOMC this week probably is prudent. You probably don't need to go massively into cash. There may still be some more upside, like say into early next year, but it is something to start maybe de-risking a little bit, given what we're heading into, probably starts to make sense. Yeah. So I mentioned the dollar already. Been consolidating recently. Had obviously its big breakout. So we've got this triangle forming here. You know, we bounced off the top again, straight back to the bottom of the triangle, but this thing's running out of room, right? So a breakout of this triangle is imminent, obviously just in time for the Fed tomorrow. Perfect timing. Personally, I favor a break to the upside on this. I don't see how the Fed's going to under-deliver on the hawkishness, to be honest, right? Versus what the market is pricing at the moment. So I think it's very likely that we get a break higher in this. And, you know, that kind of opens up targets towards 98, 99 over the next sort of few months, I guess, right? Like I say, if we get that spike in the dollar through this triangle exit, then that will give you some weakness potentially in EM, and that might be a chance to buy into that trade if you believe in the China sort of optimism story coming out. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.